I'm going to try to answer the question, can Zephyr stable dollar depeg in a critical price drop scenario? For example, if Zeph price drops 85% in 5 minutes, what would happen to the peg? So this question came up on Discord. It's a really great question because in the future, the price of Zeph could drop a lot. In fact, on October 10th, across all of crypto, a huge liquidation cascade took place because of an exploit on Binance, which had to do with a stable coin pool that was exploited. It was exploited at the pool level, not at the protocol level, and they essentially dropped the peg on that stable coin, and it caused the price of the other coins that it was paired with to go down. And then because of perpetuals and leverage longs, their positions were liquidated, which caused the price to go lower. And then that caused further liquidation. And then across the board, we see that the price of a lot of cryptocurrencies dropped significantly. This is Link, which is a blue chip crypto. It has a huge market cap. It went from $22 to $8.17, which is a 63% drop in maybe it was like 15 or 30 minutes. And then, of course, it did rebound up to $17 or so, and it moved sideways since that period of time. This is the daily candles that we're looking at here. And so it begs the question, what would happen if Zeph went down 90%, 95% in some type of scenario like this? Would it depeg the stable coin? In this type of scenario, the answer is no, it wouldn't, because over 24 hours, it actually went back up. And Zephyr has a moving average rule, which we will talk about. But before we get into really answering this, if you're not familiar with zephyrprotocol.com, you should take a look at the website. If you haven't seen my other videos, you should watch those. I'm going to get into a lot of details because really to sufficiently answer this question, there are a lot of details that an individual needs to understand to evaluate for themselves whether or not it will depeg. So in my opinion, I don't think it will ever depeg. And there are a lot of reasons why I don't think it would ever depeg, and I'm going to try to lay out that information. But this video isn't really about my opinion. It's more about laying out the facts so that you can understand how Zephyr Protocol works, whether or not you think it will depeg, whether or not you think it's a good investment, for you to evaluate if this is a project that you might be interested in. Obviously, this is not financial advice. This is just me trying to explain the details of how this protocol works so that you can be informed. Let's get into some of those details. Like I said, I'm going to do the best that I can to lay this information out in an organized manner. It's actually very difficult to kind of move through the material in a way that's organized and makes sense. If you're not familiar with this protocol and you have questions, please ask them down below. There are a lot of moving parts. I don't think I'm going to be able to cover everything. Let's just kind of jump in here. So the first thing you really want to know is that the stable dollar is collateralized by Zeph, which is a cryptocurrency that has a value. One Zeph is currently 90 cents or so. And there's 2.9 million in a reserve, which is collateralizing the stablecoin. The dollar is essentially backed by assets that are in a pool. The main thing you want to know is that there's a reserve. It's an over-collateralized pool. And again, like I said, it's very difficult to be organized because there's a lot of moving parts, but I'm going to try to say this again in a way that makes sense. So right now, or actually a couple days ago, there was $2.3 million of assets, and those assets come from the Zeph in the reserve. On this screenshot, it says that there's $2.33 million worth of assets, and that's because the 2.97 million Zeph in the reserve had a price of 78 cents, which made the value of 2.3 million assets that are the collateral that backs the Zephyr stable dollar. And then the equity is the leftover. And the equity goes to the reserve shareholders. And that equity grows over time if the Zeph price goes up over time and nobody's minting more liabilities. So if ZEPH goes to $7.80, then we'll have $23 million of assets. And if nobody mints any liabilities, then you'll have $22 million or whatever of equity, which will be split amongst the reserve shareholders. And so, there is incentive to purchase ZEPH and then to swap that ZEPH for ZRS. And that's how you become a reserve holder. You have to own ZEPH and then swap it into the reserve, and then it gets added to the reserve, and then you become a reserve holder. You get a share called ZRS, and then when you want to get out and you want to take some of that equity out, then you swap back your ZRS back into ZEPH, and you can take that ZEPH and do whatever you want with it. You can move into the stablecoin or what. And so you have something called the ZRS rate. And right now it's 1.77. Actually, I don't think that's even true. This must be an old screenshot, but let's say it is true today. What that means is if I have one ZRS and I want to swap it out right now, I'll get exactly 1.77 ZEPH. Or if I have 1.77 ZEPH, I can swap that right now for one ZRS. There is a little bit of swap fees, but it's quite negligible. So, that notwithstanding, this is what the rate refers to. It's the rate or ratio or the swap ratio that I can get between ZEPH and ZRS. The ZSD rate is pretty much the same thing. 1.28 ZEPH is equal to 1 stable dollar, and that's because the price was 0.78. If I want to get 1 ZSD, then I need 1.28 ZEPH because they're each worth 78 cents, right? And so it's the swap rate between these two. In summary, there's a pool that's filled with ZEPH, and this is filled from ZRS holders, people who bought ZEPH off the market and put it into the pool in order to get a token called ZRS. And that ZRS goes up over time. The rate tends to go up over time because it is influenced by the price of ZEPH, and it is influenced by the total minted ZRS, and it's also influenced by the ZSD that's minted. We're actually going to talk about that in a little bit, but it is the rate at which you swap your ZRS back to ZEPH, and you can see this is the entire timeline. It went from 0.5 to 1.77, and it will just go up and up over time. But there are three main factors that influence this. And keep in mind that 35% of all the ZEPH from block emissions is put into the reserve, and then it's split amongst all the reserve holders. So the reserve is the collateral that backs the stable dollar, and the value of the stable dollar comes from the collateral in the pool, and that collateral comes from reserve shareholders who buy ZEPH off the market and put it into the reserve. It also comes from block emissions. 35% of the ZEPH from each block goes into the reserve. Every 2 minutes, the reserve is getting more ZEPH. The collateral backing the stable dollar is going up every 2 minutes because of the block emissions. That's how the protocol was designed. Also, if I have ZEPH and I want stable coins, and I want to mint some stable coins, then when I do that, that ZEPH goes into the reserve, and then I get my stable coins in return. And when I want to get my ZEPH back, then, depending on what the rate is, whether the price of ZEPH went up or down, I will get maybe more ZEPH or less ZEPH, depending. If the price goes up, I'll get less ZEPH. If the price goes down, I'll get more ZEPH. Just like if I have 100 US dollars or 100 USDT and Bitcoin goes up in price, I'll get less. And if it goes down in price, I'll get more. So it's really the same thing. And the main thing you want to know is that the collateral comes from the assets that are in the reserve from every ZEPH coin, which has a price that goes up and down over time. And then the equity that's left over is split amongst the shareholders. And so it incentivizes shareholders to go ahead and buy ZEPH off the market and put it into the pool. if the rate is low, then if the price of ZEPH goes up, the rate will go up. And so when you swap your ZRS back to ZEPH, you'll actually get more ZEPH. So right now it's 1.77. If the price of ZEPH goes to $10, maybe this will go up to some number above 2. And so when I swap my ZRS back, not only will my ZEPH be worth $10 each, but I'll get more than 1.77 ZEPH. So I will have added ZEPH to the pool, and then when I swap back, I'll get even more ZEPH if the price of ZEPH goes up. Remember, there are 3 main things that influence the ZRS rate: the total minted ZRS, the ZEPH price, and the ZSD minted, which is the assets minus liabilities. That's the equity. Okay, so I designed this graph to help you understand exactly what I'm talking about with how ZRS works. And so I think I'm just going to jump into this. Right now, the ZRS rate is 1.77, and the ZRS value in USD is $1.40. And that's because for 1 ZRS, I will get 1.77 ZEPH. And if I times 1.77 times 0.78, or whatever the price was at that time, it comes to $1.40. Yeah, the price of ZEPH was about 79 cents. Right, we can see that right here. And the ZRS rate was 1.77. So that means if I swap 1 ZRS out to get ZEPH in return, I'll get 1.77 ZEPH. And if the price of ZEPH is 0.79 cents, then the value of that ZRS is $1.4. Now, if the price of ZEPH goes down all the way to 0.19, then the price of ZRS will drop significantly more than the price of ZEPH. So ZEPH will go down from 0.79 to 0.19, almost 0.2. But the price of ZRS will go from 1.4 all the way to 0.15. So it drops faster in value because it's like a leveraged position on ZEPH. And we'll talk a little bit about this in just a minute. But if you look, the rate goes down. Remember, the rate is the swap rate. It's the ratio that I will swap my ZRS back to ZEPH. So if the price of ZEPH goes to about 50 cents, then the ZRS rate will be 1.58, and I will swap 1 ZRS, and I will get only 1.58 ZEPH. And if I times that by 0.5, it will be only 78 cents of value. And then if ZEPH goes even further, the rate will drop even faster, all the way down to 0.79. And if ZEPH is only 20 cents or so, and I only get 0.79 ZEPH for every 1 ZRS, then of course I'm losing a lot of value. So if I'm a ZRS holder, then I would not want to hold it as it drops down. I would probably want to swap out. However, what you want to know is that if the price of ZEPH starts dropping, the ZRS rate will start dropping very fast. And around this area, you would want to start buying ZRS. The only way to get ZRS is to buy ZEPH off the market, and then to take that ZEPH and swap it in the wallet into the reserve, and then you'll get a ZRS coin in return, which marks that you get a share of that pool. And then if you're buying ZEPH off the market, you're pushing the price up, then you're swapping into ZRS. If other people want ZRS, they will push the market up, and then they'll swap into ZRS, and then that will push the rate up. And so really, ZRS, what it does is it actually incentivizes individuals to go ahead and purchase ZEPH off of the market, because the ZRS rate is so volatile that pushing the price of ZEPH up just a little bit can end up pushing the price of the ZRS value up very quickly. This is designed, to be this way. And, you can kind of see I've got a little image here as the price of ZEPH goes down, the collateral backing the stable dollar goes down. So that reserve ratio, which is the collateral that backs the stable dollar, will drop. And as it drops below 400%, the ZRS rate will start to drop even faster. And if you own ZRS, you actually can't swap out. There are some rules in place. If we take a look at these rules, it will make more sense. So Zephyr protocol uses a minimal JED-based implementation. We'll talk about that in a minute. ZSD minting is gated by 400% plus dual reserve ratio, spot plus moving average. So what that means is if I want to mint ZSD, I can't do it if the collateral is below 400%. I can only do it when it's above 400%. So there should always be 4 times more collateral in the reserve when I want to mint my stable coins. So we have this reserve here, and it has to have more assets than liabilities by 4x. And that's just how the rule of the Zephyr protocol works. And so, you can see like it was above, 400% at this time. So I could obviously get some stable coins. And then, if I'm a reserve holder, I actually can't redeem my ZRS and take any of the ZEPH out of the pool because that pool, that ZEPH reserve, it collateralizes the stable dollar. So it protects that stable dollar from depegging. So I'm not allowed to move out. And then I can't purchase ZRS when the reserve ratio is above 800% because that would dilute all of the other ZRS holders and it would reduce the incentive. So I can only get ZRS below 800%. If the reserve ratio is below 400%, of course, I could still purchase ZRS. And that's because it would start backing the ZSD, which is, basically I would be providing more collateral to back this ZSD. And, the reserve rate below 400%, it will drop a lot, right? So again, if the reserve rate starts to go lower and lower because the collateral is below 400%, then I will be incentivized to purchase ZEPH off the market and then to swap it to ZRS. And by doing that, I'm taking ZEPH out of the circulating supply and I'm putting it into a reserve. It's getting locked away, right? 30% of all ZEPH is currently locked away. And of course, it's not locked for any amount of time. I can get it out whenever I want, but you can see that it's there. It's not on the market. You can't buy it. So it can cause market fluctuations, price fluctuations, because there's less liquidity and there's more price discovery. And so there's also a benefit to me buying ZEPH off the market and putting it into the reserve. It removes it from other people to purchase it, and so price discovery can happen. And then I get ZRS. And so if it's below 400%, I'm really encouraged to buy ZRS because this rate will be lower and other people will be encouraged to do it. And then they will also be adding more capital or more assets that are going to back the collateral. And then if the price goes higher, the collateral goes higher, the assets go higher, the liabilities can be taken care of, the collateral that backs it goes up in percentage. And then the equity increases. And if the equity increases as a reserve holder, I actually will end up getting more ZEPH in return because the rate will go higher. It's a whole calculation. I'm not going to go into too many details. This is actually the calculation. If you're curious, it's equity divided by ZRS circulating supply divided by ZEPH price. And that's the ZRS rate. So if you are curious, you can go ahead and do that math yourself. And again, the 3 things that influence this rate are the total minted ZRS, right? That's the ZRS circulating supply, the ZEPH price, we can see that here, and then the equity, which is basically an equation of how much ZSD is minted. And again, equity is the liabilities minus the assets. You can see here, assets minus liabilities, that's the equity. And so those 3 things, basically this equation here, influence the ZRS rate. So you can calculate and think about in the future, with block emissions, you can actually do a calculation and find out exactly what the ZRS rate will be in the future if all things stay the same and 35% of the block emissions keeps getting added every 2 minutes to the reserve. You'll be able to calculate exactly what that rate will be. And so, if you're interested, I could provide some of that information. But okay, so hopefully, that gives you kind of the main understanding of exactly how ZSD works. It's an over-collateralized stablecoin. It's backed by a cryptocurrency, and there are other projects that are somewhat similar to this. and there's a reserve ratio that is a percentage of collateral that's backing. So we have eight times more assets to the liabilities right now. The screenshot was taken today. And then you have the moving average. So this is something that I haven't talked about, but I'm going to jump into that now, and we'll talk about a few other things. So I have 3 factors that will protect the ZSD peg from depegging. The one that I've talked a lot about is the moving average, probably because it is one of the most important features. It's a rule that will prevent the peg from depegging. And let's just talk about that briefly. So again, the way that it works, it's a VWAP, volume weighted average over 24 hours. And so we can see yesterday I took this screenshot, the price was 78 cents. Today it's 90 cents. So once 24 hours has passed, this moving average will move up to 90 cents if this stays at 90 cents. And so then these prices will align, and then it will make sense to swap in and out between ZEPH and the stable dollar and the reserve, because the rule is such that whenever you swap in the wallet, you will always get the worst of these 2 prices. Again, the reason that this rule is in place is so that nobody can manipulate the price of ZEPH, so that they essentially can take advantage of how the spot price works, and then they can move in and out of the stable dollar or the reserve by manipulating the spot price. So it's a lot harder to manipulate this price because you have to take into account the 24-hour average. And so it's a protective mechanism that was designed, and I think Zephyr protocol team actually is probably one of the first to do this. I'm not familiar of any other blockchains that have this type of rule in place, but essentially you have to have these 2 align for it to make sense. The reason that's important is because if the price drops in 15 minutes down 85%, then the spot price will go down, of course, but the moving average will not really move very much. The reason this moving average is in place is because it slows everybody down. There's really no sense in me swapping my Zephyr stable dollars back to ZEPH if the price is such that I'll get it at the moving average price. And that's really how it would work. I wouldn't get it at the spot price because I'll get the worst of the 2. So if this goes down to 0.05 cents and I go to swap it for ZEPH, I'm going to be swapping at this price, and I'll only get a few. You would get the worst of these 2, and so you wouldn't want to swap out. You'd wait for this spot price to come back up. Like I was saying before, if this goes down to 20 cents, like I was saying, then in that scenario, over 24 hours, the ZRS rate would start to drop because the moving average of that ZRS rate would drop, right? And so that's something that you need to understand. So I'm going to take a second to really explain this. So if the spot price went down to 10 cents or to 19 cents, which is what I have on the graph, let's say it goes a little bit lower just because we want to get a depeg situation. What will happen is over the next 24 hours, the moving average will come down to 5 cents or whatever, but it will tick down slowly. And as it goes down every 2 minutes, people will take advantage of that because the ZRS rate will drop. It will start to tick down slowly. So if this goes down to 5 cents, this will essentially go down to like 1. And then this will be at 80 cents or something, and this will be 1.7 or whatever, 1.78. And then it will slowly tick down over time. And even if this is below 100%, this will not be. And as it slowly ticks to below 100% or towards it, then people will start to buy ZEPH off the market because they'll want to swap it into ZRS because the rate will be so good. And in doing that, they will push the price of ZEPH up, or they will protect the price by purchasing it off the market and putting it into ZRS, right? So really, that's one of the main mechanisms that prevent it from depegging. It could drop really fast. However, the moving average will drop slowly, and as this ZRS rate comes lower and lower and lower, at some point, there will be a huge incentive to purchase ZEPH off the market and swap it into ZRS, which takes ZEPH off the market and puts it into the reserve, which collateralizes the stablecoin. It reduces the supply that's in the order books on centralized exchanges, which can increase, supply shock and increase price discovery to the upside. It collateralizes the stablecoin because there's more ZEPH in the reserve. By purchasing it, I also push the price higher. If other people are doing that because they want to get into ZRS, that will push the price higher. And of course, then that would push ZRS back up. And so it protects the peg simply by the fact that the moving average is so slow that it gives everyone an opportunity to purchase ZEPH at a low price at the spot price. And then as the moving average starts to drop, at some point they can swap it into ZRS and they can get that really low ZRS rate. And then if ZEPH price starts to go back up, even just like if it rebounds, again, these things always rebound. So if it does rebound, then the ZRS rate can go up so much. I could get, let's say, 100 ZEPH for 10 cents, and then I could swap it at a rate of 1.0. So then I'll get 100 ZRS. And then if ZRS rate goes back to 1.5 because it rebounds and the price goes back up, therefore the ZRS rate goes back up, then that 100 ZEPH turns into 150 ZEPH. And I bought it at 10 cents and now it's worth maybe 50 cents. So the actual value of ZRS goes up much faster. So the USD value, and that's this red line here. So I might buy 15 cents worth down here, but if the price of ZEPH goes from 20 cents to 40 cents, ZRS goes from 15 cents to 57 cents. So it has more volatility, and also it goes without saying, because I've already said it, that if you hold ZRS, you get 35% of the block emissions. So it's really kind of a long-term hold also. You just want to keep getting those block emissions because the actual equity will go higher and you'll be able to reap that equity at some point in the future because the rate will go higher. Again, this rate will just go up and up over time. And so that's because of block emissions, also because of the price of ZEPH. So ZEPH actually went to $52 over this period of time, right over here, and then it went down, right? And it went back up to like $30, and then it went down and down, and it went down all the way to here, went down to, right around here, went down to 50 cents. But ZRS, basically just went up and up, and that's because it's protected by block emissions, and it's protected by other factors. Remember, the ZRS rate is an equation which we talked about. So, okay, so we've talked now at length about the other protective factor, which is ZRS rate becomes much more appealing if the price of ZEPH drops. And if it drops, if the spot price drops really, really fast, then the moving average will follow it over 24 hours. And if it stays really low, then the ZRS moving average rate will follow it, and it will become appealing, and people will have to buy ZEPH off the market, which will bring the price back up, and then they can swap into ZRS, and the moving average will essentially then follow the spot price again. If the spot price is going up because people want ZRS and they're buying ZEPH off the market to get into ZRS because it's much more appealing, then they'll go ahead and purchase that ZEPH and put it into ZRS, and then the spot price will go higher, and the moving average will then follow that spot price back up as we see here. Also, people might not want ZRS, but they will want ZEPH, and they'll just buy it at a cheap price, and it will just rebound naturally anyway, right? So there's obviously that. And the other protective factor is that you can redeem ZSD at any time, whenever you want. So if the spot price drops down, then you can redeem it whenever, but you really should wait until the moving average matches. And so probably what will happen in this type of scenario, if it goes down 85% in 5 minutes, then it will probably rebound because people will want more ZEPH. Some people will want to get that ZEPH at a good price and then wait for the moving average to match the spot price and then move into ZRS because that's going to be a lower, more appealing rate. And those two factors will push the spot and the moving average back up. And then the ZSD person can go ahead and unmint their ZSD. They can burn it. They can send it back into the protocol, and they will reduce the liabilities by doing that. And if there's less liabilities, you can simply do the math here. then the reserve ratio will go up. Because if I remove 50,000 ZSD, then the assets that back it, you could do a calculation here. The equity will be such that the collateral that backs that liability will be higher, and you can simply do some math and figure all of that out. Really, I've explained most everything. Now I'm just going to try to give you a little bit of background and bring all of these thoughts together. And I realized that was really disorganized, but this is very difficult to explain. Okay, so just to really hit this home, how does ZSD work? Right? I've explained this, but I'm going to explain it in very simple terms. It's a stablecoin that's backed by ZEPH, which is locked in a pool. It's like a bank. When you add ZEPH to that bank, you can mint ZSD. You can also lock ZEPH in the bank and get ZRS, right? So the bank is the reserve. It's where all of the ZEPH is collected. And this is the bank account. Everybody can see how much is in the bank account. ZRS holders supply ZEPH to collateralize ZSD in exchange for the potential of receiving more ZEPH in the future, because the price of ZEPH will likely go higher, and ZEPH price influences this rate, and because 35% of all the ZEPH from every 2-minute block goes into the reserve, which also increases the ZRS rate. And you can see how many reserve holders there are. There's about 1.4 million ZRS circulating, and they have a share of this ZEPH, as well as the ZSD holders. They have a share of this as well. And those are the people who have claims to the reserve. And so there are some rules which we've talked about that are in place for how you can interact with this protocol. There's only certain times that you can purchase and redeem, and you always have to get the worst of the spot or the moving average. And all of this is a minimal JED-based implementation. And so I just want to quickly talk about that, because I think a lot of people will benefit from understanding this. So on August 17th, 2021, this paper was published, and this is from Input Output Global. They are from the Cardano ecosystem, and they essentially have this verified crypto-backed pegged algorithmic stablecoin. It's called JED, and it says here, I'm going to read this and then I'm going to go through my ChatGPT simplified version so that it makes more sense. It says, this paper describes JED, an algorithmic stablecoin protocol that behaves like an autonomous bank that buys and sells stablecoins for a price in a range that is pegged to a target price. So this first sentence is extremely misleading and very difficult, I think, for most people to understand. It's not algorithmic in the way that Terra Luna was algorithmic, and in the way that it would automatically, through like an automatic market operation, purchase and buy stable coins or base tokens in order to keep the peg. That's not what it means. It means that it's a code, it's a protocol that autonomously will allow individuals to interact with the wallet, with the bank, and swap ZEPH to ZSD and ZEPH to ZRS. And the protocol will allow, within the rules, to buy or take those ZEPH and put it into the reserve, and then to take that ZSD, or to mint ZSD and give it to the individual, or to mint ZRS and give it to the individual. If you're swapping ZRS back to ZEPH, then it will automatically, through code, take that ZRS and burn it, and then give you ZEPH in return. And that's really all this first sentence is saying. It is a crypto-backed in the sense that the bank keeps a volatile cryptocurrency in its reserve. So in this case, it's ZEPH. The paper here is about Cardano, so it's talking about ADA. But in the case of ZEPH, the volatile cryptocurrency is ZEPH, and all that means is it goes up and down in value. That's what volatile means. A stable dollar doesn't go up and down in value. It's not volatile. It's stable. It's relatively stable pegged to the US dollar, which of course loses value over time. But there's a huge need for stable coins because you can basically hedge against the price of something going down by moving into a stable coin. And there's obviously a lot of other reasons, but that's one of the main reasons. It says here the reserve is used to buy stable coins from users that want to sell them. So what it means is that the wallet, the Zephyr wallet, the protocol, um, the reserve itself will take the stablecoins back, and they will issue ZEPH from the reserve. So it allows you to sell them to the bank. So if I have a stablecoin, I can give it back to the bank and they'll give me ZEPH in return for the exact amount of value that I have in that stablecoin. So if I have $100 of ZEPH stablecoin and ZEPH goes from $1 to 50 cents, then I will suddenly get 200 ZEPH, but I'll get exactly $100 worth. So I always get that same value. And the opposite is true. It says revenue from sales of stablecoins to issuers are stored in the reserve. What it's saying here is when I want a stablecoin, I will give it ZEPH, and it will take that ZEPH and it will store it. It's not going to destroy it. It will keep it in the reserve. And then it will mint a stablecoin and give it to me. And so whenever I want to mint a stablecoin, it will actually take my ZEPH. I need to buy ZEPH off of the market and lock it into the reserve, and that collateral will then allow this bank to autonomously, automatically, through an algorithm, which is what the wallet is, in order for me to get ZSD. Besides stablecoins, the bank also trades reserve coins in order to capitalize itself and maintain a reserve ratio significantly greater than 1. So for ZEPH, it has the Zephyr reserve share. And this is the reserve coin that collateralizes the stablecoin. So I can go ahead and interact with the wallet, which is an autonomous algorithmic protocol. It's a bank, it's a wallet that I can interact with that will allow me to get ZRS, or the reserve coins, in return. And this will significantly collateralize because I'm adding ZEPH, which is extra ZEPH that did not mint any ZSD in return. It just minted ZRS in return. It says here, to the best of our knowledge, this is the first stablecoin protocol where stability claims are precisely and mathematically stated and proven. Furthermore, the claims and their proofs are formally verified using 2 different techniques: bounded model checking to exhaustively search for counterexamples to the claims, and interactive theorem proving to build rigorous formal proofs using a proof assistant with autonomous theorem proving features. So this is like an 87-page article that you can look at. It's on the internet. It's like 60 pages of math. If you're interested in learning about this, they have a minimal JED protocol and an extended JED protocol. Zephyr protocol uses the minimal version, which doesn't have like dynamic fees. From what I understand, the extended one uses some fees that shift over time, and Zeph didn't really need that implemented. And Zeph actually has changed their fees a little bit, and they're actually really great in my opinion. So just to make this super simple for everybody to understand, I had ChatGPT simplify that abstract summary from that paper. And it says here, when people want to buy the stablecoin, the smart contracts mints and sells new coins and adds the payment to the reserve. So it mints and sells stablecoins, and then it takes your ZEPH and adds it to the reserve. When people want to sell their ZSD, the contract buys them back using the money in the reserve. To keep the reserve strong, the system also allows people to buy and sell another token. In this case, it's a coin, and it's called ZRS. It's a reserve coin. These reserve coin holders take on more risk, but earn rewards, helping the system stay well-funded. We've talked about the risk and rewards there a little bit. Unlike most stablecoin, JED price stability rules are not just assumed, they're mathematically proven and formally verified with 2 methods, model checking and theorem proving, to ensure the logic is sound and free from hidden flaws. So I found this kind of interesting. I was pronouncing this wrong before, so I apologize about that. I did not know this was an ancient Egyptian symbol, but it is. And I'll just note really quickly that since this paper was written, there's been other protocols, which we could take a look at a few today if I have some time. And none of them have ever depegged. So that's noteworthy. Zephyr stablecoin also, by the way, the ZEPH that collateralized it went from $52 to 50 cents, and the stablecoin never depegged during that period of time either. And that's because you could redeem your ZSD at any time, and because of the moving average slows everybody down. And the third factor is the appealing ZRS rate. As the price of ZEPH goes down, people will want to purchase it and add it to the reserve, which backs the ZSD. It collateralizes it, and then they get an appealing ZRS rate. Which, if you take a look at the ZRS rate over time, it has gone up quite a bit. And if you bought it during this period of time, you'd have a lot more ZEPH if you swap back today. So there's a lot of good reasons why it's never depegged. And I just want to point out quickly, because I found this actually quite interesting, the JED symbol represents stability, endurance, and permanence. It is also known as the backbone of Osiris, which also means strength and stability. Egyptians of ancient times believed that JED was a combination of four main pillars that form the Earth's foundation by holding it steady on those four corners. And you can see what the symbol looks like here and here and here and here. So I found that kind of interesting. What also is kind of serendipitous is that Zephyr stablecoin has four coins. It has ZEPH, it has ZSD, it has ZRS, and it also has now ZYS. And so I found that kind of interesting, but mostly just coincidental. Okay. It says here the moving average of ZEPH price would drop over a 24-hour period, bringing the ZRS rate down with it, which would lower the ZRS rate. I've already talked about that. That is one of my main arguments, is if it went down really fast, 90% in 5 minutes, in the next 24 hours, everybody would have an opportunity to jump into ZRS as it went lower. But the only way to do that is to get ZEPH. And so, that obviously would protect the peg, because you would be adding collateral to the reserve, which would essentially help to back the stablecoin. And by purchasing ZEPH off the market to get into ZRS, you obviously are increasing the price of ZEPH. And so the whole mechanism, the whole point, the reason they designed it this way was because it protects the peg. That's the whole point. They designed it with a reserve coin that influences people to collateralize the peg as the price drops. And then as the price goes up, the reserve holders get rewarded for that price volatility, as we looked at with that chart. So it was designed and researched and mathematically proven and theoremed out to be very well working. It's never depegged. I don't think it's ever going to depeg for this reason and for the reasons that I've laid out. And really, just to hit this home, how does the Zephyr protocol differ from automatic buyback stablecoins? So there is another stablecoin that uses JED. It's designed by this cryptocurrency called COTI, and it actually uses Cardano ADA as the volatile cryptocurrency that backs it. So it's equivalent to ZEPH in this case. And it does not use buybacks on the market, and it relies on arbitrage between the contract, the native protocol, and DEXs and centralized exchanges to balance it out. So this is very similar to ZEPH. So this is kind of what I'm comparing it to. And then you have UST. This is Luna, which uses minting and burning. And it does use algorithmic market operations to essentially mint and burn Luna in order to back UST. And that's why there was this huge death spiral. It's using on-chain swaps, and it's partially automated to mint and burn Luna in order to keep the peg. And so there was a cascade effect that took place that caused it to death spiral. And there is an automatic algorithmic way in which it actually holds the peg. With the JED protocol, it doesn't use algorithms to hold the peg. It uses collateral in a reserve and reserve holders to keep the peg. And whenever I want ZSD, I have to take ZEPH and add it to the reserve, which is collateral. And then other people can add ZEPH to the reserve and not get ZSD. They get ZRS, and that backs it. It's an algorithm. It's an autonomous bank. It's a wallet. It's a protocol. It's a code. But it doesn't use algorithm that is automated to mint and burn a base token in order to maintain the peg, like Luna, which caused Luna to get destroyed and billions of dollars was wiped out overnight. Frax is very popular, actually, and uses a very complicated system that also uses an automated market operation to maintain the peg as well. And I wouldn't be surprised at some point in the future if Frax actually has a huge depegging situation. It's actually very complicated how it works. I don't know all the details. It's like a hybrid collateral system. So it's a little bit maybe more safe. It's like maybe a combination of these two. It says here uses an algorithmic market operations to buy and sell on DEXs. So yeah, it's kind of sketchy. I would avoid it. DAI, D-A-I, is over collateralized, and it's very similar to how JED works, but it is different. It says here that it's a peg maintained via arbitrage and collateral auctions. So yeah, I mean, it's talking about the peg in this situation, like in pools and stuff, but at the protocol level, it's always $1 for Zephyr protocol. So one thing I want to point out here quickly is that DAI comes from MakerDAO, I believe, and it's collateralized in a pretty interesting way, where if the collateral that backs the stablecoin, which is called DAI, it's one DAI is $1, then there's like this liquidation process that takes place where it will sell BTC. Let's say you have BTC instead of ZEPH, and it's collateralized by 400%. If it drops to 200% to back the stable dollar, it will actually liquidate that stablecoin and sell it on the market, and then it will collect and keep make sure that there's always 100%. So it's actually quite different in how it works. And then because MakerDAO has been so successful, they actually have something called Savings DAI, which is SDAI. And I want to take a look at that really quick because I think a lot of people don't realize how this works. This is Savings DAI, SDAI. And if you look at the price of this over time, it starts at $1 and it just goes up over time. It never goes down. Right? This is just how ZYS works. It's exactly the same. So it's not like ZYS is the first thing to ever do this. DAI is a stable dollar that gets more value added to it from certain mechanisms that MakerDAO uses. I'm not going to go into detail, but I just really quickly wanted to point this out, that it's not unheard of to have a coin that only goes up in value. The problem is that DAI goes up extremely slowly, whereas ZYS goes up much faster because it uses a different source for its yield than the sources of yield for DAI, which I've talked about in a previous video. But the point that I want to make here is that when ZYS goes to Ethereum, and because the stable dollar is never going to depeg, and Ethereum has DeFi Llama, and it's going to be connected into MetaMask and Trust Wallet and all these other features, people will actually see charts like this for ZYS, and then they'll realize, wow, what is this? It's going up really fast, and then they'll buy it. And that will actually push the market cap of ZEPH higher, and the ZRS rate will go higher, and then the equity will go higher, and the stablecoin will be over collateralized more, and then they can buy more ZSD, and the whole flywheel effect kind of takes place. And so, that's all coming in my next video. So this is kind of a preview. Okay, so I just want to end the video by summarizing a few of the main points here. This video went way longer than I expected, but as usual with Zeph, when you want to explain one thing, you really kind of have to explain everything. And in summary, ZSD is likely never going to depeg because the moving average will slow everybody down because of the way that JED technically works. It is designed not to depeg. It's a different type of stablecoin that uses a collateral mechanism, and that collateral is incentivizing people to jump into ZRS, which takes ZEPH off of the circulating supply, moves it into the reserve, which collateralizes the stablecoin, and pushes the price higher, and then the moving average will follow that. And there are rules in place that are happening here. So if you guys have any questions, or if I got any information wrong, or if you think there's something I missed, if you have any arguments against this, I really welcome all of that. Not trying to say like this is perfect. I'm just trying to put the information out there and see if anybody, can teach me anything that I might be missing. because I don't think I'm missing anything. And I think that when Zeph goes to Ethereum, the market cap is going to 10x. And actually, I think it's probably going to 100x. I've already talked about this. I'm buying more Zeph all the time, as much as I can. So, I believe that this is going to go higher. And, one of the reasons why I put these videos out is because I'm trying to get feedback about, where I might have some blind spots or what other people might think. If you got any value from this video, hit the thumbs up, subscribe, and I'll see you in the next video.